Hello everybody, welcome back to the channel. My name is Jeremy. I am the Stock Brother and you are on the Stock Brother channel. Welcome back today. Today we are going to get into a subject that I have been wanting to talk about for a long time and that I tend to talk about on a regular basis with people that I just happen to have in my circle. We're going to be talking about dividends today. Now this is a big subject. Everybody get yourself ready because that's what we're talking about today. All right. Now, before we get into that, let me say a couple things. Thank you to all the people that have subscribed to the channel. You don't know how much I appreciate it. Keep subscribing, keep liking, keep sharing, and keep watching the whole video. I most definitely appreciate everything that you all are doing for me when it comes to supporting the channel. And that being said, let's go ahead and get into this. Now, what is a dividend? A dividend is a distribution that a company gives to its shareholders out of its income. Now, one of the main reasons why a company gives a dividend to its shareholders is because a lot of companies don't necessarily have volatile stocks. And when I say that, I mean the stock price itself doesn't go up and down a whole lot. So there's not a lot of volatility there. So what they do is these companies, they will give you a dividend or issue a dividend to their shareholders, basically to entice you to own and hold their stock. They don't want you in and out of it. They want you to get it and hold it. So they figure if they give you a distribution, then you're more likely to hold their company's stock. So next, we're going to get into some types of dividends. Now, the first type of dividend you want to know about is a cash dividend. Now, cash dividend is going to be given from a company's cash that they have on hand. Whatever they might have on their balance sheet. Some companies have a lot of cash, some companies don't. But for the most part, if a company decides to give a cash distribution, it's because they have cash on hand to give you. Now, the second type of dividend we're going to get into is a unqualified dividend. Now, what makes a dividend unqualified is because of the fact that there is a holding period on a dividend or a dividend stock. So if you buy a dividend stock today, there is a 365-day holding period that you have to hold that stock in order to make it qualified. Right now, we're talking about the unqualified dividend. So, of course, you must have held that stock less than 365 days. Again, unqualified dividend, less than 365 days. On the other hand, if you hold it past the 365-day holding period, that's considered to be a qualified dividend. Now, qualified dividend is different. Of course, you have the differences in the holding period, whether you held it or not for the 365 days, but it also determines how that dividend is going to be taxed. Now, an unqualified dividend is taxed at your regular tax rate. Whatever income bracket that you fall into, that's where your dividends are going to be taxed at. Now, if you do hold it for the entire 365-day holding period, it's a qualified dividend, and a qualified dividend is going to be taxed at a long-term capital gains rate, which is basically in the United States about 15%. So it might not seem significant when you're talking about small sums of money, small sums of dividends that you're receiving. But if it is a large sum of money and it is a large sum of dividends that you're receiving, it definitely matters. So, and it's most definitely a significant difference between the 15% qualified dividend rate or your regular tax bracket, which could be anywhere up to 20% or more, 25% or more. So you have to keep that in mind. Now what we're going to do is we're going to get into what we call a dividend yield. All right. Everybody get your pens and your paper together because this brother is fixing to start talking about numbers. And you are absolutely right, brother. I'm finna start talking about some numbers right now. So, like the brothers say, I hope y'all got your pens and I hope you got your paper ready. Now, when you talk about calculating a dividend yield, I'm going to give you all an equation right now that you can always use to calculate a dividend yield no matter what the stock price is, no matter what. If you're ready, we're going to take the dividend amount. You're going to divide it by the share price, and that's going to give you your dividend yield. Again, you're going to take the dividend amount, you're going to divide it by the share price, and that's going to give you your dividend yield percentage. So whenever you take a look at a dividend stock, or whenever you look at the metrics on a dividend stock, it's going to have a couple things. It's going to have a dividend amount there. And they're also going to show you the dividend yield percentage at that particular time. Now, that dividend amount will stay the same. Now, a lot of companies will raise that dividend on an annual basis. Some of them will keep it the same. Some of them will cut it. But in this case, we're going to say that that dividend amount is going to stay the same. Or for the most part, that dividend amount stays the same for the year. Now, the stock price, of course, goes up and down on a regular basis. On an every trading day basis, the stock price is going to go up and down. So let's get into an example here. Say I have a stock here, and this particular stock costs $100 a share, right? Now, this stock also pays out a dividend, and the dividend amount that they pay out is $5. So in this example, we have a stock price of $100 and we have a dividend amount of $5. Now, if we go back to our equation, you're going to take the dividend amount, in this case is going to be the $5, and you're going to divide it by the stock price, in this case is going to be $100. And that's going to give you your dividend yield of 5%. Basically, $100, and I pay a $5 dividend, so I am paying out 5%. That is going to be the dividend yield there. Now, let's kind of stick with the same example. Let's say now that dividend amount on that same stock is still $5, right? But in this case, let's say that the stock price went up to $150. So you have in your equation, you have your $5 dividend amount, and you divide that by the stock price. And at this particular point, the stock price is $150 now. So when you do the equation, that's going to give you a dividend yield of 3.3%. So as you can see, the dividend amount stayed the same. The stock price changed. It actually went up from $100 to $150, which made the dividend yield go down. That means you're getting $5, but it's a $150 stock. So your dividend percentage is going to be 3.3%. Now, on the flip side, if we have our dividend amount, which is $5 in our equation, and let's just say that the stock price goes down to, let's just say $65 a share. So you're going to take your $5 dividend amount, you're going to divide it by the share price as of right now is $65 that it went down to. And that's going to give you your dividend yield percentage of 7.6%. So what you need to do is understand that the dividend yield does change. It's going to be based off of the stock price right now and the dividend amount at this particular time. So moving on here, now we're going to get into some actual dates that you have to remember when you talk about dividends. Now, the first date that you have to remember is going to be the declaration date. Now, on the declaration date, that's a good date. I love the declaration date because that's the day when they decide they're going to pay you some money. That's when they decide or basically declare that they're going to be issuing a dividend. Now, they'll give you the date, they'll give you the times, the day, the amount, all of that they'll give you on the declaration date. They might even decide to declare that they're not just going to give you a dividend for this quarter or for this month. Depending on if it's a monthly paying dividend or a quarterly paying dividend. They might decide that they want to give you or declare that they're going to give you a dividend this month, next month, and the month after that. You just kind of have to be watching for those dates and listening and reading for the declaration date for the company that you own. Now, secondly, we're going to get into another date here. And this date is going to be the ex-dividend date. Now, on the ex-dividend date or the ex-dividend date, it basically is the day that you have to own the stock by in order to receive the dividend. And when it comes to the ex-dividend date, I'll tell you this. Make sure you own the stock a day before the ex-dividend date. Now, that's just a little bit of advice from me to you. It's kind of like a little rule of thumb. Make sure you own it the day before the ex-dividend date. If you buy it on the ex-dividend date, you probably will not get the dividend. I'm almost certain you won't get the dividend. Now, that leads me into the next date that we need to talk about, and that's going to be the record date. Now, the record date is usually a day after the ex-dividend date, and the record date basically is the date that behind the scenes, the company and the platform that you use, they're basically trying to decide who's going to get this dividend. Because as you know, The stock market is a bunch of people selling stocks and a bunch of people buying stocks. So they have these dates put in place when you talk about ex-dividend dates and record dates to find out who actually should get the dividend for this quarter or for this month. Is it the seller of the stock or is it the buyer of the stock? So again, ex-dividend date, rule of thumb, own the stock before the ex-dividend date. Then you don't have to worry about the record date because the dividend is going to come to you. Gotcha. Now, let's get into the last date, which is the most important date, one of the most important dates other than declaration date. It's the pay date. So when you talk about a pay date, the pay date is the best date going when you talk about dividend stocks. I love it and everybody else would love it too. So now, please don't play with these dates. Don't try to get in and out of these stocks and buy before the ex-dividend date and try to get out right after and try to get the dividend. The thing about it is that, and what a lot of people don't know about dividends is that if you do buy a stock and you buy it before the ex-dividend date, most of the times when they issue out this dividend or when they say they're giving out this dividend, the stock price itself will fall just as much as the dividend that they're giving out. Now, don't get me wrong, stocks do rebound, but if you're trying to jump in and jump out, it's kind of like a lose-lose situation because of the fact that you're not really gaining. You're gaining the dividend, but you're losing on your capital gains when you talk about the actual stock price. So please, we're here on this channel. We are about long-term investing, and that's what we do. So you all don't play with these dates. Just get in, buy it, hold the stock, it doesn't matter. Just hold the stock, keep the stock, and hold it for the long term. Watch your dividends grow. Now, when it comes to dividend investing, one tool that I want you to really go check out and play with for a while. If you're going to dividend invest, then you probably have to play with this tool at least for a little bit. It's called a compounding calculator. Now, with a compounding calculator, you can play with. You can put in the years that you want to invest, or how many years you want to invest, how much you want to invest, how much a month you're going to put in there, how much dividends you're going to put in there, and it will calculate what your portfolio or what your account will look like dollar-wise in that certain amount of time, in a certain amount of years. If you're going to dividend invest, go play with a compounding calculator. You can kind of Google it. Moving on. Keep in mind that a dividend can get cut. It can get cut at any time. So just keep that in mind, understand. And the thing about it is, again, we're intelligent investors here. If a dividend does get cut, you should feel comfortable enough with the decision that you made to buy the stock, that if they do cut the dividend, that you are still comfortable with holding the stock. Now, just so you understand, a company does not have to keep their dividend. They can and will cut the dividend if they have to. So keep that in mind always. Next, we're going to get into dividend payout ratios. Now, this is something that if you're a dividend investor as well, you should all take a look at when you talk about a dividend payout ratio. What that is basically the percentage of a company's income that they pay out to their shareholders. So, for example, if I have a company and my company made $100 this year, and I have to pay $35 of that 100 out to my shareholders, my dividend payout ratio is going to be 35%. Same way if I had $65 that I had to pay out to shareholders, then my payout ratio, my dividend payout ratio would be 65% at that point. You want to be looking for 75% or lower with the dividend payout ratio with the companies that you're looking for. It could be higher. It just depends on what type of company you're looking at. A lot of REITs have very high payout ratios because, again, they have to pay 90% of their income out to shareholders. So it might look a little different if you're looking at a REIT, but for the most part, regular companies that you look at, they will have a dividend payout ratio. And again, you want it to be lower than 75%. That way they can use the other money that they have left over to grow the business, to invest, to do whatever they need to do to make the business better. Now let's talk about a couple of different status quos, or a couple of different status symbols that a lot of companies, a lot of dividend companies want to achieve. The first one is called a dividend aristocrat. Now, dividend aristocrats They basically have grown their dividend annually and have never cut their dividend for 25 years. Now, I'm going to give you a resource to go and check out a whole list of dividend aristocrats. It's going to be ticker symbol NOBL. That is going to be the Dividend Aristocrats ETF. All of those companies in their portfolio are dividend aristocrats and have grown their dividend, not cut their dividend for at least 25 years. So that being in mind, we'll get into the next status symbol. It's going to be a dividend king. Now, a dividend king is just that, the king of the dividend stocks. They have raised their dividend, haven't cut their dividend, and have paid the dividend for at least 50 years. So with all that being said, hopefully you have gained enough knowledge on this video to grab some dividend stocks, be able to grab them and look at these companies intelligently and put some of these into your portfolio. And hopefully you got a lot of value out of this. Again, subscribe, smash the thumbs up button, and I will see you all on the next video. Thank you.